Hello, friends, and welcome to Cafe Mutual YouTube channel. Friends, we all know that debt funds have not performed well for the past few years. In fact, most categories of debt funds have given less than inflation returns. The tax googly further added to the woes of fixed income investors. To know whether debt investing still makes sense and what is the future of debt markets, today we have with us Vivek Sharma, Fund Manager Fixed Income, Nippon India Mutual Fund. Vivek has over 16 years of experience in fixed income market. So without wasting time, let's welcome Vivek. Good evening, Vivek.
Thank you, Nishant.
Okay. So Vivek, as you know that uncertainties around interest rate, inflation, and other global events continue to exist. So let me start by asking the most common question in everyone's mind today. What is the near-term outlook on debt market?
So Nishant, last 1 year has been really volatile. Rather, I should say, really bad for debt markets because yields have risen significantly in last 9 to 12 months. This was owing to hikes by global central bankers and domestically also by RBI, which was due to spiraling inflation, which was an outcome of normalization of economy, which opened up after two waves of COVID, and then Russia-Ukraine crisis, which flared up, the commodity prices across board, be it metals, agri-commodities, crude oil prices, which were at their peak in, early 2022. So central bankers started reacting to it by, hiking rates very aggressively. In India, we have seen almost 250 basis of rate hikes in last 9 to 12 months. From 4% repo rate on RBI has taken it up to 6.5, which has led yields on 1 to 5 year assets to rise, similarly by 200 to 250 basis points, and which in turn resulted in mark-to-market losses in debt portfolios, where investments are there in 1 to 5 year or maybe also on the 10-year part of the curve. So, but right now, after all this, I think we have seen the peak of inflation. Inflation numbers have started coming down, and going forward, as projected by RBI as well, inflation is expected to be in range of 5.5% for the next financial year. Similarly, on the global front, again, inflation has started coming down in US from peak of close to double-digit numbers. We are around 6% and is expected to fall to close to 3.5% by this calendar year. So in this backdrop, I think we have seen the peak of rates going forward. There are a couple of months which would be very significant in terms of incoming data on macro fronts. Last 2 3 months have been a mixed bag for macro data. On domestic front, we have seen CAD numbers improve significantly, but on the other side, we have seen inflation, though has been coming down, but it at much lower pace. So, what I think markets would be watching for next 2 3 months would be the pace of the slowdown in inflation, and on the global front, how US Fed is reacting in terms of doing rate hikes further, or they will take a pause in the next upcoming policy in the first week of May. And secondly, for RBI, I think they would be vigilant on the impact of current heat wave, which is sweeping the country, plus the incoming monsoon season, which is very critical for our food prices. And as we know, Indian inflation basket comprises almost 40 to 45% of food,
Mhm.
so which will have a significant impact on our inflation numbers. But as of now, we think we are in line with the RBI's projection of 5 quarter for the next financial year. Basis that market expects RBI would stay on pause at current level of repo rate, and possibly as and when the inflation number moves in the comfort zone of RBI and the focus shifts from the fight against inflation, and RBI starts supporting growth, we might see rate cuts coming in. So I think in crux, the worst is behind us. Possibly we are at stable interest rate environment for next 6 to 9 months, and then interest rates might start coming down.
Okay. So Vivek, over the last few years, we have seen heightened volatility in debt funds too. In fact, a certain section of distributors believe that if they were to take such a risk, they would instead recommend equity funds or hybrid funds. And you know that with LTCG going away, The case for hybrid funds over fixed income funds became stronger among distribution community. So I wanted to know your view on this.
The basic premise of investment, I think, on a debt fund is obviously asset allocation. Like we all know, debt funds are typically inclined more towards, accrual incomes, unlike equities, which are inclined towards the growth. So investors look for a lesser riskier, investment with less volatility vis-a-vis equities when they invest in debt. And debt gives you a larger clarity or visibility in terms of, future cash flows with much lesser volatility vis-a-vis equity. So as an asset allocation, obviously one needs to invest in debt and equity both, but the mix could definitely be, determined based on person's risk appetite and his ability to take volatility in the near or the short term. And debt funds can be used for, achieving your short to medium term goals by seeing a visible cash flow of money over next 3 to 5 years. That's a typical investment horizon where person looks at investment in debt products. Secondly, like you mentioned, for the hybrid funds, I think typically if you look for a tax advantage in a hybrid fund, you are looking at a aggressive hybrid fund wherein at least 35% of investments are in equity. So the broader returns which are generated in any such product would be predominantly because of equity, and debt plays a passive role there, giving some bit of accrual income without taking much of the risk on that portion of the portfolio. So as an asset allocation, that might suit to a particular portion of your portfolio, but entire debt allocation cannot be shifted in a hybrid fund because volatility is almost similar like any equity fund, and the risk profile is very different. So from that perspective, I think both funds have different investment profiles and risk appetite for investors. In terms of tax, I agree. I mean, we have seen, LTCG gone from mutual funds, but still mutual fund debt schemes offer, traditionally a similar amount of returns vis-a-vis any traditional instruments which is available in the market, with the benefit of very superior liquidity proposition which exists in a mutual fund without any penal interest or any other hindrance in terms of generating liquidity out of debt products. Secondly, on the tax part, you still have advantage of deferred taxation in a mutual fund debt scheme, unlike any traditional product where you need to have a TDS or accrue or account for your taxation in those assets. In mutual fund, you tend to defer tax until you have redeemed your money. So from that perspective, opportunity cost plays an important part still.
Okay. So talking about corporate bond fund, which is one of the, I mean, highest, largest category in the debt space. So this category has not performed well over the last 1, 3, and 5 years. Even if we take the long-term performance, it has not performed so well. So why do you think that MFDs should recommend corporate bond funds to their clients?
One thing, Nishant, is corporate bond funds have not done well for certain reasons which we discussed earlier,
Yes.
like post-pandemic rates were at abysmally low levels when RBI infused system with a lot of accommodation in form of higher liquidity and rate cuts in March, April 2020. At those times, rates had fallen significantly, and post-normalization after COVID waves, we saw inflation picking up and rates moving up, which led to yields going higher. So that has been one reason in last couple of years where we have seen impact on debt funds. But again, one needs to look at similar alternatives at that point in time when they entered in these kind of products. Say a 3 year back, what kind of option was available to investor vis-a-vis a corporate bond fund, and what kind of return those instruments have delivered, and what a corporate bond fund has delivered. So just to give you a perspective, I think a corporate bond fund over last 1 and 3 years has given returns in excess of 6% on an average across various schemes. This is the average return. I'm talking of the category from mutual funds. So six quarter return over 1 to 3 year, I think stands still much better vis-a-vis any traditional instrument which was offering at that point in time. If you remember, overnight rates were close to 3 quarter, 3 half when RBI had cut rates in 2020. So similar maturity, other alternatives were offering you somewhere around 4, 4.5, or max 5% at that point in time for this kind of investment horizon. That's one part. And these events happen. This was, one of a binary kind of a event which happens, which one cannot be prepared for. The COVID, which we have seen globally and domestically. So we can't, compare last 3 years is not a, real picture of how these funds perform over a longer period. And broadly, debt products like a corporate bond fund, which invest on intermediate duration part, are probably suggested to investors for 2 to 3 year kind of investment horizon. And the expectations are typically in the range of 7 to 8% over that period of investment in Indian debt markets. I think these funds have fairly delivered that kind of returns in past as well, and possibly going forward, we can expect similar kind of returns from these products.
Vivek, having said that, but the Nippon India Corporate Bond Fund has outperformed its benchmark over 3, 5, and 10-year period. So it has one of the outlier in terms of performance. So what are the two things that has contributed to this performance?
One, I would say, is the basic construct of the portfolio, how we have run this fund in the past. While, since there is no limitation in terms of duration, which one fund can run in this category as prescribed by SEBI. So, which gives the fund manager a lot of flexibility in terms of, managing duration in different points in time, in different market conditions.
Mm,
So the main benefit which has accrued in this fund is due to dynamic duration management over last 5 10 years,
mm,
where basis market conditions we have quite disciplined in a disciplined manner. We have maintained the duration of this portfolio. In last 2 3 years, like I mentioned, when the rates were at abysmally low levels, we were running duration at much lower levels, close to 1 1.5 years. And when we were expecting rates to go up to cushion our investors from any MTM impacts during the rising yields, and which has helped us also in last 3 years in terms of performance vis-a-vis the category, because we were running much lower duration. And since, like I mentioned, at appropriate time, we have increased duration of this portfolio. Currently, we have taken duration close to 3 years, since we expect yields have peaked, and absolute yields of 7.5 8% looks very attractive proposition for investment. So that is one primary reason how this fund has performed over last couple of years. Secondly, a disciplined approach in terms of the fund casing which we have in our AMC, wherein every scheme has defined fund casing in terms of risk and credit parameters, what fund can do, what kind of exposure one can take, even in good markets or bad markets. We have limitations of individual asset level duration, credit issuer level restrictions, which are much stricter than any regulatory allowances which are allowed by the regulator for the category. So, which brings in a lot of discipline in investment, which restricts fund manager from going overboard on either side in good or bad markets, and protects from any unforeseen event which might arise, be it on the credit front or on the rates front.
okay. Vivek, however, the last 1 year has not been so good for the fund. So what are the strategies that you have deployed to regain the momentum of the fund?
Harshad, like I mentioned, last one has been bad across for the debt schemes because of almost 200 250 basis yields moving up in across the asset classes, and the significant impact has been on the short end of the curve, where this kind of product typically invests predominantly in 1 to 5 year assets, with repo rate moving from 4 to 6%. Yields in AAA assets have also moved in line with the same proportion, so which has led to MTM losses in corporate bond fund as well, but albeit to a lesser tune. And like I mentioned, the fund has generated return in excess of 6% over last 1 year. To compensate for that, I think, like I mentioned, fund has increased its duration close to 3 years, and rightly poised and positioned currently to take advantage of any fall in yields which we will see going forward over next 12 to 18 months due to RBI rate action. And current carry of 7.5 also is giving investors a in fact, without any capital appreciation, 7.5 kind of a carry offers a very good proposition, so which would broadly compensate to an investor who has invested for a 2 to 3 year kind of investment horizon.
Okay. So Vivek, the fund has an 8% cash holding. So what's the reason for this?
That's more, the reason since on the month ends in March, there was a gush of money which flowed into mutual funds. And what happens when you have a lot of surplus inflows coming in, you don't want to deploy that at one go. So the larger cash holding in the portfolio is reflective of that inflow of money, I think, right now. But we have deployed that over last couple of weeks, and currently the cash position is much lower to 2 to 3%, and it doesn't reflect our view on interest rate at all. So we wanted to deploy. It was just that the flow was humongous in the month end, so we didn't deploy it at once. We wanted to deploy that uh, while taking into cognizance all the factors.
Okay. So Vivek, one last question. Why should MFDs recommend Nippon India Corporate Bond Fund to their clients?
One very simple reason I would say, as a part of asset allocation, one should invest in debt. In debt, at current juncture where we are and how this fund is positioned, like I mentioned, close to 3 year kind of a duration, which is a sweet spot for any investor who's looking to park their money for 2 to 3 years and want to capture higher absolute yields which are available in the market right now. The fund has a YTM in excess of 7.5%, and it has a proven track record. What you yourself mentioned currently, that we have managed this portfolio with agility and and delivered risk adjusted returns for our investors over a longer period of time. And secondly, again, a very unique feature of fund casing vis-a-vis any other fund in the industry which is there in this portfolio, and unique to a Nippon AMC product, which is not there with any other AMC currently, which gives in a very disciplined investment philosophy, and investors are aware upfront what they are getting into. They know what a fund manager can do, what a fund manager can't do in this portfolio. All limits are defined upfront, so it gives a much larger clarity in terms and visibility to investor while investing in this product, in terms of the duration and product profile, and which can lead to his expectation on returns from this portfolio over his investment horizon.
Okay. So all right, we have come to an end to this interesting session. Thank you so much, Vivek, for your valuable time and inputs.
Thank you, Nishant. My pleasure.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.